The world reels from Brussels' unprecedented decision to seize Russian central bank assets, a move that until recently was considered unimaginable in the realm of international finance. The shockwaves are immediate and far-reaching. Europe confiscated $105 billion, aiming not only to punish Russia for its actions, but also to fund Ukraine's massive reconstruction needs. This is financial warfare on a scale rarely seen. But this bold act has triggered global shockwaves, undermining decades-old financial norms and sending markets into turmoil. The foundation of trust, sovereign immunity, has been shattered, leaving the global financial system on uncertain ground. Nations once believed their reserves in dollars and euros were untouchable, protected by international law and mutual trust. Now, Europe's action signals that in times of conflict, even the most sacred financial rules can be set aside, raising questions about the future of global finance. What was meant as a clever, non-military punishment has backfired, creating unintended consequences that ripple across continents. Countries outside the West see this as a dangerous precedent, not a principled stand. Many now wonder if their own assets could be next. Russia's retaliation was swift and decisive, seizing European assets in response and escalating the standoff. Billions belonging to European corporations are now trapped in Russia, with businesses facing sudden losses and uncertainty. The deeper impact is clear. Trust in the Western-led financial system is eroding, and confidence is slipping away. Central banks worldwide are rethinking where to store their wealth, quietly moving reserves and diversifying away from traditional safe havens. The very idea of a safe asset is being redefined, as gold and alternative currencies gain new appeal. Instead of isolating Moscow, Europe's move may have accelerated the fragmentation of the global economic order, pushing countries to seek new alliances. The world is shifting toward financial multipolarity and unpredictability. With new power centers emerging, the rules of global finance are being rewritten in real time as nations scramble to adapt to this new reality. The consequences are only beginning to unfold, and the full impact may not be known for years. The era of unquestioned Western financial dominance is over, replaced by a world where trust is fragile and the future is uncertain. Freezing sovereign assets isn't new, but outright confiscation marks a dramatic shift in international finance. For decades, nations have relied on the security of their reserves held abroad, trusting that even in times of conflict, these assets would remain untouched. Even during the Cold War, when tensions between East and West were at their peak, the West never seized Soviet central bank reserves. The idea of crossing that line was considered too risky, too destabilizing. But in 2022, the EU and G7 took unprecedented action, immobilizing $300 billion of Russian assets in response to the invasion of Ukraine, sending shockwaves through the global financial system. By 2024, they escalated further, seizing profits generated from these frozen assets, over $105 billion, and redirecting them to support Ukraine's war effort and reconstruction. This move was both a powerful symbolic gesture of solidarity and a practical funding source for Ukraine, demonstrating the West's commitment. Yet the decision was fraught with legal and economic risks, raising questions about the sanctity of international agreements and the rule of law. Experts warned that such actions could undermine the global dominance of the euro and dollar, as other nations might seek alternatives to protect their own reserves. Central bank reserves represent the collective wealth of a nation's people, not just the property of their leaders or governments. By targeting these reserves, Europe directly challenged the long-standing principle of state sovereignty and the trust underpinning the global financial order. Even the European Central Bank itself issued warnings about potential reputational damage and the risk of eroding confidence in Western institutions. Still, political imperatives and the urgency of the moment overrode caution, pushing leaders to act despite the risks. Now, the safety of sovereign assets in Western banks is no longer guaranteed by tradition or law, but increasingly by shifting geopolitics and alliances. The rules have changed, and not everyone is comfortable with this new reality. As uncertainty ripples through markets and boardrooms worldwide, the world is watching closely, and trust in the global financial system is wavering as nations reconsider where and how to safeguard their wealth. Russia's response was immediate and calculated, leaving no room for doubt about its intentions. Moscow announced mirror measures, swiftly targeting Western corporate assets and investments within Russia's borders. European and American companies, once symbols of international cooperation and economic partnership, suddenly became hostages to geopolitics. Factories, energy projects, and bank branches were seized or nationalized, often overnight, as Russian authorities asserted control. The value of assets lost by European firms quickly matched, and in some cases even surpassed, what Europe had taken from Russia. Russia targeted countries most vocal in supporting the EU's policy, intentionally sowing division and uncertainty within Europe's ranks. European businesses, now facing huge and unexpected losses, began questioning the wisdom and long-term impact of the original seizure. The pain was no longer abstract or distant. It hit boardrooms, shareholders, and workers directly, disrupting lives and livelihoods. The illusion that business could operate above politics was shattered, replaced by a harsh new reality. International investment law, once seen as a shield, now offers little protection in this unpredictable new era. Political risk now overshadows market dynamics for multinationals, making every decision fraught with uncertainty. No investment is safe from state retaliation, as governments assert their power over global commerce. Companies everywhere are rethinking their global strategies, reassessing where and how they operate in a changed world. The age of apolitical globalization is over, replaced by a new era where politics and business are inseparable. The Russia-Europe standoff sent shockwaves through central banks worldwide. The assumption that sovereign assets are sacrosanct is gone. Nations now fear their reserves could be seized over political disputes. Central banks hold reserves to stabilize economies, not as bargaining chips. The seizure of Russian assets injected geopolitical risk into reserve management. Quietly, countries from China to Brazil are rethinking where and how they hold their wealth. The trust that underpinned the system for decades is broken. Central banks are now seeking ways to de-risk their holdings. The shift is gradual, but the search for alternatives is urgent. The global financial order is entering a new era of caution. In response, central banks are diversifying away from the dollar and euro. Gold is back in vogue, physical, unseizable, and trusted. Countries are repatriating gold from Western vaults, prioritizing sovereignty over convenience. The gold rush signals a loss of faith in traditional reserve currencies. Beyond gold, nations are trading more in local currencies. Russia and China settle most trade in rubles and yuan. India buys oil in rupees. These are not isolated deals. They're part of a global trend toward de-dollarization. Alternative payment systems like China's CIPS are gaining traction. Regional payment networks and central bank digital currencies are emerging. A parallel financial universe is taking shape, less efficient, but more resilient to Western pressure. The old system's convenience is being sacrificed for security. The world's financial architecture is fragmenting. Trust in Western finance is no longer a given. The energy market is ground zero for de-dollarization. For decades, oil was traded in dollars, cementing U.S. financial power. The Russian asset seizure changed that. Russia now demands payment in rubles or non-Western currencies. China and India get discounts for paying in yuan or rupees. New shipping routes and insurance systems bypass the West. A parallel, de-dollarized energy market is emerging. Even Middle Eastern giants like Saudi Arabia are considering accepting yuan for oil. The goal isn't to collapse the dollar, but to create a more balanced, multipolar system. Less trade in dollars means less global demand for the currency. The US and Europe face new financial constraints. The weaponization of finance is accelerating the shift to a multipolar world. Was seizing Russian assets a victory or a costly mistake? Supporters say it was a moral stand, funding Ukraine and punishing aggression, but critics argue the long-term damage to Western financial trust outweighs the gains. The system's strength was its neutrality and predictability. By weaponizing finance, the West has driven countries to seek alternatives. The $105 billion seized is dwarfed by the trillions now reconsidering Western markets. European firms suffered tit-for-tat losses in Russia. The move accelerated de-dollarization and alternative payment systems. In punishing one adversary, the West may have empowered many competitors. The appeal of Western finance was stability. Now, that's in doubt. Short-term moral victory may have cost long-term influence. The price of lost trust is only beginning to be understood. The trust crisis is reshaping global financial centers. London, New York, and Frankfurt once thrived on legal certainty and stability. Now investors question whether assets are truly safe from political seizure. Capital is quietly shifting to hubs like Singapore, Dubai, and Hong Kong. These cities offer neutrality and protection from Western sanctions. Western hubs still have deep markets, but their dominance is no longer assured. The world may split into rival financial spheres, each with its own rules. Rebuilding trust will be a long, difficult process. The precedent of asset seizure lingers. Without credible assurances, Western centers risk slow decline. The new era demands more than just efficiency. It demands real security. The seizure of Russian reserves was a turning point. The era of a single, Western-dominated financial order is ending. A multipolar, fragmented system is emerging, defined by caution and self-interest. Trust, once the system's foundation, has been shattered. Countries are building alternatives, diversifying away from the dollar and euro. Gold, alternative payment systems, and regional hubs are rising. The West's ability to use financial sanctions is diminished. The world is recalibrating and the old rules no longer apply. The genie of asset seizure cannot be put back in the bottle. Western nations must adapt, using financial power more cautiously. Trust is a finite resource, easy to lose, hard to regain. The financial world of 2024 and 2025 is a testament to that hard lesson.